How to Beat Inflation. Hi there, it's Luigi and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we are going to help you find ways on how to successfully survive inflation. So if you dig these kinds of videos, then keep on watching. The inflation scare is in full swing. When an economic frenzy of any type strikes, we usually find it helpful to break things down in a sensible, practical manner. Only a minor percentage of the overwhelming noise and worry is correctly focused on whether the present inflation statistics are transitory or are here to stay for a while. The demand-side data represents what most of us have experienced since April of 2020. A significant increase in demand for products as people have spent more time working, exercising, and playing from home, and a decrease in demand for services as people have spent less time out. The increased demand for products has resulted in significant supply chain bottlenecks, and more money chasing fewer accessible items leads to inflation. This isn't just a US phenomenon, it's occurring all throughout the world. Inflation and your locus of control. Let us first discuss what we can and cannot control. For starters, no one person, not even the President of the United States, has the authority to mend the global supply chain, control gas and oil prices, or flip the supply and demand dynamics in the housing market. In terms of the prices we pay for various goods and services, we are all at least partially hostage to the markets as they now exist. If, for example, a monopolistic internet service provider or toilet paper maker decides to take advantage of this position and overcharge customers, we don't have much of a choice except to grin and bear it. What do we have control over? Much more than we realize. Personal finance, in its simplest, purest form, can be distilled into two categories. What we make, which is our wages and/or investment income, and how much we spend. And whether we lose ground against, stay up with, or decisively overcome inflation is determined by how well each of us performs in these two critical areas. Whether inflation is temporary or permanent, there is plenty we can manage within both categories that can allow us to not only break even, but even come out ahead if we play our cards well. How to beat inflation with income variables. 1. Income from wages. Let us begin with salaries. If you haven't already, now is an excellent moment to make a case for a raise or promotion, and if you aren't currently getting one, look for a better paid position. Why? When inflation rises, salaries nearly invariably rise as well. In the United States, average hourly salaries have increased by 4.8% year on year. Much of this has been driven by the Great Resignation, since there appears to be nothing like a life-threatening, door-shuttering health epidemic to make individuals re-evaluate their existing employment conditions and put in the effort to locate better, higher-paying jobs. Most sectors of the economy are experiencing a labor shortage, as the number of individuals quitting their employment in 2021 hit an all-time high. The number of striking workers is at its highest in decades. Businesses are in severe need of staff. Workers haven't felt this powerful in a long time, by almost any metric. It may be easy to remain quiet while others are empowered, but this is a dangerous tactic that might result in lesser income growth. 2. Income from long-term investments. Historically, equities have had a mixed track record during periods of high inflation. But more often than not, stock markets outperform inflation during these periods and over the long run. Staying predominantly invested in equity shares rather than cash is critical to staying ahead of inflation over time. 3. Income from medium-term investments. Meanwhile, with current interest rates hanging just over 0%, any medium-term savings for significant forthcoming purchases such as vacations, autos, medical operations, housing, and etc. lying in cash or low-interest bank deposit accounts are losing purchasing power over time. With this amount of money, we'd recommend looking at Series I savings bonds issued by the United States Treasury. I bonds are designed to perform at or near current inflation rates, and the current I savings bond rate, which is revised every 6 months, is 7.12% APR. I bonds must be held for a minimum of 1 year before they may be cashed out, and there is a 3-month earned interest penalty for issues redeemed before 30 years. Online, you can purchase up to $10,000 in I bonds per social security number every calendar year. Furthermore, if you are looking for short and medium-term investment alternatives as an inflation hedge and supplement to your portfolio, real estate, gold, commodities, and inflation-linked bonds tend to do well during periods of high inflation. The problem with these forms of investment hedges is that they are only transitory, and it is practically hard to time the market so that only these types of assets are invested during inflationary periods. If inflation falls, which is unavoidable but unanticipated, these assets are likely to follow suit. 4. Income from cash flow. Then there's the monthly cash flow bucket. This is the cash you should retain in highly liquid bank accounts in order to pay your bills on a monthly basis. You should be able to discover a number of high-yield savings accounts that will pay a few percent APR on balances under a certain amount, like $10,000, $20,000, and etc., with a little Googling. Over time, this is the least significant of the 4 buckets. The objective here should be to limit the amount of money in this bucket to just what you require for monthly cash flow. You're unlikely to beat current inflation rates with this bucket, but you don't have to. Saving a few dollars in earnings power is less significant than maintaining liquidity. In other words, don't get too worked up over interest rates. How to beat inflation with spending variables. Make informed, categorical spending decisions, like auto, gasoline, and food. We can't just add up all spending because price inflation is different for different types of spending, and having some categorical inflation data can help you make smart spending decisions. Inflation as a whole is at 6.8%, but prices of non-food and non-energy goods have only gone up by 4.9% in the last years, with a big chunk of that coming from the auto industry. Because there aren't as many new cars on the market because of a shortage of microchips, prices for used cars and trucks are 46% higher than they were 2 years ago. Prices of new cars are higher for the same reasons, though not as much as before. Think manufacturers' suggested retail price serving more as a floor than a ceiling. It seems likely that the auto industry will fix this problem with the supply chain, and when they do, prices will go back to where they were. If you can wait to buy a car until that happens, you will be better off. Even looking at older used cars, buying only the cheapest new cars, or using short-term leases could help bridge the gap until the auto market is more consumer-friendly. Buy in bulk, but don't hoard. Food seems to be the other big area where prices have gone up a lot and are important right now. Some of these price hikes are because of the problems in the supply chain. Some are also because people are stockpiling. Some are because climate and weather are making crop yields worse, and some are because gas and diesel prices are going up. Companies that have a monopoly or oligopoly in their market, like those that sell paper or meat, are more likely to raise their prices during this time just because they can. Temporarily change your consumption preferences. With the price of meat going up, for example, would it hurt to switch a few meals a week from a protein source that comes from meat to a protein source that comes from plants? Inflation can be scary, especially when the media and your peers may make it sound worse than it really is. The current high inflation numbers are temporary, but whether they stay high for a long time or go away soon, it's important to know that there are many things you can do on both the income and spending sides of your personal finances to put yourself in a much better position. And that's it for this video. If you enjoyed it, make sure you leave a like, subscribe, and hit the notification icon. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.